Master Finance. On today's episode, we will navigate into the intricate world of financial restructuring. I'm your host Inês, and we are dissecting the challenge faced by companies using the case of Famosa as our guide. I have with me some very special guests, Ana, Sara, Diogo and Francisco from JP Morgan, and they will help us understand this case.
Hello everyone, I'm Sara. To begin with the discussion, I will present some of the challenges Famosa faced. In 2009, Famosa faced financial distress due to factors such as leverage buyout and the debt-financed acquisition of its competitor Faber. Struggling with working capital needs and difficulty securing short-term financing in challenging markets, the management team faced the options of bankruptcy or debt reconstructing and chose debt financing to avoid forced asset sales at undervalued prices. The decision aimed to restore financial stability and create favorable conditions for future sales, considering the long-term outlook. Now, looking at Famosa's new strategy, this strategy aims to transform the company into an international entity based in Spain, adapting classical toys to meet consumers' preferences. The shift in production to China seeks cost efficiency while maintaining some production in Spain for logistical and quality reasons. Acknowledging the sensitivity of products during economic downturns, Famosa's successful internationalization relies on securing sufficient resources and making strategic adaptations. The strategy focuses on modernizing classical toys, especially dolls, while minimizing costs through production in China. Adapting to diverse consumer preferences and integration technological innovations are important. Strategic partnerships and customized marketing approaches aim to boost global product promotion. However, the company faces challenges such as international regulations and cultural barriers. A phased expansion, starting with companies similar to Spain, would help the company minimize the negative impacts and achieve a more stable experience for future diversifications.
In the 7-year period from 2010 to 2016, Famosa's free cash flow paint a positive picture as can be seen in the slide. This upward trend signifies a robust and healthy financial trajectory, underlining the company's viability and strength. Analyzing the free cash flow to equity indicates that the company not only covers its core operation expenses, but also its debt servicing obligation without major concerns. Besides, the absence of significant fluctuation exhibits stability, crucial in an industry heavily marked by seasonality. Given the positive trajectory and improved outlook post-restructuring, Famosa has strategic opportunities to allocate its free cash flow to equity. Our recommendations are as follows. Firstly, Famosa should prioritize debt repayment to address financial challenges and enhance flexibility by amortizing its outstanding debt. This strategic allocation demonstrates the high commitment of the firm to addressing its current financial issues. They also should build cash liquidity by allocation a portion for working capital needs in order to meet short-term obligations, which has been an increasing concern over the past years. Additionally, the company ought to evaluate strategic investments that could emerge as opportunities for strategic capital expenditures aligned with the company strategy. An example would be the redesigning of classic toys and dolls. Finally, Famosa should perform a contingency fund which sets aside for unforeseen events or economic downturns, providing stability in a seasonal industry.
But there's a relevant question that we need to ask. So, should all of the free cash flows be put towards debt servicing? Well, if we think of the hypothetical case that Famosa wanted to repay half of its outstanding debt, that could be achieved by 2016 through the total allocation of the free cash flows to the equity towards this end. As you can see, by 2016 the firm would have had amortized 47 million euros out of the total 89 million euros of debt. However, while prioritizing debt servicing in the initial years is crucial for credibility, a phased approach is recommended. Firstly, Famosa should focus on debt repayment until achieving a gearing ratio of 60%, which is that of the industry. And this can be done by allocating half of its free cash flows to the equity yearly to the debt amortization. Afterwards, once this is secured, Famosa can then diversify allocations, balancing immediate obligations with sustainable long-term growth. And to do so, our previous recommendations, apart from the debt payment prioritization, they would suit perfectly. Now, moving on to the estimation of the terminal sale value. Well, obviously, the weighted average cost of capital was pivotal, and its initial value, determined using the CAPM model, it was of 6.47%, while the stable growth phase WACC, based on the Bloom method, is projected at 6.48%. Then the terminal value, calculated at 421 million euros, holds significant implications for potential sales and financial restructuring. This valuation incorporates the present value of future cash flows, debt reduction impact, and restructuring measures, providing insights into Famosa's ability to meet debt obligations and overall viability post-restructuring.
Zooming in on key profitability indicators of Dupont analysis, we focused on return on equity, which evaluates the return on shareholders' equity, and return on assets that measures the efficiency in utilizing assets to increase sales and profits. Regarding the return on equity, we observed losses in 2010 and 2011, but from 2012 onward, return on equity turned positive, reaching 30% in 2016. Concerning the return on assets, we assessed Famosa efficiency in generating profits relative to invested capital, increasing from 3.6% to 70.8% in 6 years. The financial restructuring in 2009 aimed at rebuilding confidence with financial institutions. Analyzing operating results from 2010 to 2016, we observed positive trends in EBITDA, EBIT, and net profits, reflecting favorable outcomes. Furthermore, we addressed the issue of residual value in 2016 to understand Famosa's appeal to potential new investors. The company's residual value is 421.52 million euros, and investors of the capitalized syndicated loan will receive 51.57 million euros at the end of 6 years. With 12.23% of the company, investors of the capitalized syndicated loan will be reimbursed exactly for the amount invested by the time of the company's sale. Despite the restructuring benefits Famosa's performance in general, the profitability for the financial institutions as new shareholders by the time of Famosa's sale depends directly on the ownership percentage in the company. It is important to highlight the protection the capitalized syndicated loan offers to investors in case of an unfavorable company sale. We explore scenarios where the investor's ownership percentage is crucial. A lower percentage than 12.23% will result in smaller reimbursements to the investors, so in this case they will prefer to act as creditors instead of shareholders. However, a higher percentage than 12.23% will ensure larger reimbursements. In such situations, investors would hope to be reimbursed for the amount they are entitled to as shareholders rather than as creditors.
A financial restructuring journey is no walk in the park. After a thorough analysis at Famosa's financial landscape, the company set clear objectives and developed a restructuring plan, as we saw. One of the most daunting tasks in this process is negotiation debt with financial partners, as Famosa was at a point where banks are turning down proposals for new credit lines. But even before diving into negotiations, seeking professional advice from financial and legal experts is a must. Their insights can help draw a strategic roadmap and navigate the complexities of financial restructuring successfully. Now, navigating through negotiations isn't a one-size-fits-all. Famosa, being a sizable company, had relations with various banks, and leverage these relationships can be very advantageous. However, it is crucial to keep all options open, as one institution might not be willing to shoulder all the risk. But that's not all. The presentation of a comprehensive business plan, as are explained, for the next 6 years is fundamental. Banks may know about the current situation, but they need to see the projects and strategies. Realism is key, but showcasing positive perspectives ensure the banks see financing Famosa as a profitable venture. It is also important that the company recognize the reasons that led to the current situation and explains how they plan to solve and improve them. As negotiations progress, anticipating questions is crucial. Does the program CapEx imply an actual investment increase, or does it correspond to the depreciation value? Ensuring forecasted free cash flow from 2010 to 2016 cover interest, tax and scheduled investment is paramount. Transparency about the nature of financing, operation or capital is also key. In these tight times, offering reasonable collaterals is also a wise move to smooth the deal with financial institutions. We should also take into account that credit markets liquidity is also thin, which means that from the financial institutions' point of view, they have few eggs to distribute for all the baskets. So in the end, we must convince them why they should choose Famosa. Well, that wraps up today's episode of Dr. Master Finance. We hope this deep dive in Famosa's financial restructuring offers insights for the curious one and maybe some inspiration for those facing some similar challenge. Join us for the next episode for some more financial wisdom. Until then, stay tuned and financially saving.